All right, welcome back, part 2. We are going to split the rest of these and analytical measures into 2 categories. Liquidity and solvency, that's number 1. Basically, can they pay their bills, right? How liquid is the company? And then the other one is profitability. So what is the company's future of being profitable here? The point of the ratios or any of these calculations we're doing is we want to be able to compare a company from one year to another, right? That's the idea, is the predictability factor. So we want to be able to see a company's on a steady incline or a steady decline, or if a company's volatile, that's not necessarily one that is very popular to invest in. You also want to compare to industry, other ones. So like you saw with the common size statements, we can compare Home Depot and Lowe's, even though their numbers are very different. We can compare how one company is doing with another based on looking at their overall just percentages in the vertical ratios. So what are solvency ratios? They measure the ability to pay bills, right? Solvency meaning how liquid are you as a business? Your ability to manage critical assets. So things like inventory, accounts receivable, those are considered very liquid items. So, yeah, along with cash, of course. So those are some of the ones that we focus on. Profitability is measuring what is the ability to earn a profit, right? That's what we're really looking at with that one. Now, the solvency measures we're going to be covering, the first 3 are short-term. The remainder that are in here are long-term solvency measures, right? So it's important to break them into 2 pieces, because short-term is about paying the bills currently, or how liquid are you currently. Long-term, 5 years, 10 years, and so on. We are going to skip 2 of these, okay? So that means, don't worry, I won't put them anywhere. We're going to focus on some of the bigger items, which is ratio of liabilities to stockholders' equity. We're going to skip a couple of the measures overall. Those are 2 of the ones we're not going to be looking at. All right, so the first one, probably one of the most common ones, is working capital. Working capital is how much, if you have all your current assets, right, which means short term, your current assets, and you subtract all of your current liabilities, right, that's all the bills you have to pay within the current year, do you still have money to work with? That's your capital, that's your working capital. Now, most of the time you'll see it as a ratio, current assets divided by current liabilities. So if we come on over here to our Home Depot and we look at our current assets, right, there we go, and we grab our current liabilities, total current liabilities, there's a bunch of them, and we divide one by the other. Okay, so 19,810 divided by 18,375. We can see that Home Depot has $1.08 of current assets to every dollar of liabilities. So they're good. They can pay their bills and a little bit more. Okay, and if you look at the previous year, there you go. You can do that. Lowe's, we're going to grab the same information. You've got current assets, you've got current liabilities, so it's going to be the 15,318 over the 15,182. They're also ahead of the game, right? They can pay every single bill that they've got coming with the current assets that they have on hand. So they're, Home Depot's better, and you're going to find that to be the case with most of these. Anything less than 1 would be a little concerning, because it means that they don't necessarily have all the cash or liquid assets on hand to pay their bills. All right, so obviously the best in here, the best of all these 4 numbers is right here, the $1.11. Okay, there's something called the acid test ratio. It's also referred to as the quick ratio. Sorry, I'm going to move myself out of the way. Assets that can be immediately converted to cash. So this is a slight twist on what we just did. By making the denominator still current liabilities, but the numerator is quick assets. Quick assets meaning your most liquid assets, so cash, accounts receivable, things that you're going to expect to have cash in your hand very quickly. Inventory takes a little longer. Inventory is a short-term current asset, but it's hard to sell off all your inventory and turn that into cash fast, right? So that inventory is definitely one of the ones we do not consider a quick asset. All right, so let's take a look. So this is like just really more of a stringent calculation. So if we look at Home Depot, definitely cash, definitely receivables, not inventory. Not inventory because, like I said, it's hard to sell off inventory fast, right? Not other, because we don't even know what other is. And we're just going to grab those top ones there. So we've got the numerator, same denominator, 23 cents. And that makes sense because Home Depot has a ton of money tied up in their inventory. Okay, so it's not that it's bad. It's just a matter of, like, really cash on hand. They only have 23 cents to every dollar of liability that they owe. And guess what? People don't like getting paid in like hammers and nails. So it's a concern, but it's typical with an inventory heavy company. All right. Lowe's, you can grab the same information. Cash, short-term investment. That's one we didn't say. If it's a short-term investment, meaning you turn it around and have it be cash really fast, that's going to be something that gets included. Inventory is not. Other is not. So we're going to grab those guys, put them over the current liabilities. Far worse. 6 cents. 6 cents, right? So in that case, the Home Depot is the better option, or has the better ratio. Okay, so I'm in the way again. How about I go down here for now? Things that you would typically include in here: cash, receivable, short-term investments. And that's not an all-comprehensive list, but that's pretty much the ones you're going to see. Definitely not inventory, okay? Oh, you might see the terms marketable securities. All right. So let's start looking at some of the other calculations. Accounts receivable turnover. This is how quickly during the course of a year receivables get collected, right? So the idea is if you expect your people to pay the bills that are owed to you, because that's what a receivable is, within 30 days, then I would expect my receivables to turn over 12 times during the year, because people have a 30-day window, which is a month. All right, so that's what we're kind of looking at here. We've got sales on account divided by average accounts receivable. So you want to look at things like your credit policies. Like I said, if you tell them you expect to be paid within 30 days, then I would expect to see a 12 here. If I don't, then that's a question. Do people, if I see like a 10 here in my credit policies, or that I expect to get paid within 30 days, it means people are paying their bills late. That's my concern. So, you have to follow up with people, pay your bill, have good credit policies, maybe penalize them, I don't know. But the idea with the turnover, right, is how long is it goes from an accounts receivable to being collected to having a new receivable, right? How often, what is the cycle of people paying their bills? So if we have net sales on account, we have to be given that number, because we really don't know there's no information we have anywhere that tells us what our sales are on account, meaning somebody who owes us a receivable versus somebody who pays us cash right at the very beginning. So we have to be given that number for this analysis. So you got 15,800 over average accounts receivable. Now that's a tricky thing. When you see the word average accounts receivable, what they mean is beginning of the year plus end of the year divided by 2, the average. So we've got the end of this year plus the end of this year, because the end of this year is really the beginning of the next year, right? So you're going to look at these two together, add them, and divide them by 2 to get to the average number. All right. So that is 2021, and you're at 7.8. That means 7.8 times during the year, receivables are collected. Previous year, 9.3. You collected them more quickly, right? The better number is higher here. So you're actually better off in the previous year. You're worse off in the current year. Okay, number of days. Now this is kind of just a step further on the same calculation. Number of days sales and receivables. So the idea here is, all right, it takes people, 8 times throughout the year to pay me. How long do we tell them that they have for receivables to be collected? Like, how long does a receivable sit on my books before my people who owe me money pay me? All right, so the good thing is you have average accounts receivable from the previous problem. That was your denominator, now it's your numerator. And average daily sales. Daily is your key word here. So you're going to take sales on account, that same number, divided by 365, because I want to know the sales for one day. That comes out to be 46.7 days. That's how long it takes for a receivable to get paid to Home Depot. Previous year is 34.2. People paid faster. And we want people to pay faster because we want our bills paid, right? We want the money that is due to us as quickly as possible. So in this year, it's taking people longer to pay us. Now, if like my billing term is 45 days, I'm okay. I'm not in such bad shape. People are taking 46 days to pay me. It's not terrible. But if my billing period is 30 days, like that I tell people you better pay me in 30 days, like that's what goes out on my bills, then I was kind of okay in 2018, but I'm really not okay in 2019. So that's when it comes into the credit terms you're offering and such. Okay, so we're going to do something very similar with inventory. Inventory is cost of goods sold over average inventory. When you see that average number, know you're going to have a calculation ahead of you. Inventory management, right? Think about inventory. You have to make sure a company who carries inventory carries it well. And by that, I mean you have to make sure that your inventory is not becoming obsolete. You got to make sure it's safeguarded, it's not damaged. You got to pay warehousing, right? So inventory is an important item for us to be looking at to make sure that it's being handled well. Opportunity costs, like if I'm sinking all my money into inventory, what else could I be doing with that money? That's an opportunity cost. So the idea is, how long does it take me from the point that I bought inventory to selling the inventory to replacing that inventory? What is the cycle there? How long does inventory sit on my shelves throughout the year? So we're not looking at days yet. That's going to be the next calculation. What I'm saying is how many times during the year do I have to refill my inventory stocks? All right. So cost of goods sold is our numerator right there, divided by average inventory. So again, beginning plus ending divided by 2. All right, that comes out to be 5 times. 5 times during the year, the inventory is kind of cleared out and replaced on the shelves. Is that good? Is that bad? I don't really know. It comes down to what the others are, what the industry is, what previous years are, but let's compare it to Lowe's. Let's grab Lowe's numbers. So if I, trust me, those are Lowe's numbers. Do the math. Oh, I'm in the way again. There, go back up there. 3.8. So their inventory sits on the shelves more than 2 times more than, or about 1.5 times more longer than Home Depot does. So inventory is sitting on the shelves longer at Lowe's, and that's not a great thing for them, right? Inventory is expensive. You want it to go and come, right? Come in and go, and come back in and go. All right. So now the question is how many days? How many days does that translate into? So we're going to take that again before average inventory over average daily cost of goods sold. So average inventory is going to be the denominator for the other problem. It's going to be the numerator in this one. Average daily cost of goods sold, you're going to take the cost of goods sold number divided by 365, right? So you see that word daily in there. That's going to be your moment you remember that. That comes out to be 71 days. That's how long it sits on your shelf, 71.5 days. Again, a good, bad, I don't know. It depends on how they've done against other years, how they do against similar types of companies. So let's grab Lowe's numbers. And inventory sitting on their shelves for 95 days, which makes sense because the turnover number was lower, so we expect that that inventory sitting on the shelves longer. Okay. All right, so those are our short-term measures. I'm going to hit one more real quick, and then we'll get into profitability. Ratio of liabilities to stockholders' equity. Now think about how you're buying your assets and such. You're getting them, right? Or your assets equal your liabilities plus your stockholders' equity. Do you want to be buying your assets from your liabilities, like you owe the money on them? Or do you want to be buying your assets from stockholders' equity, meaning stockholders' equity is where your retained earnings and such are? So it's kind of like, how many liabilities, like how leveraged are you as a company? Are you using liabilities to run your business, or are you using the money you've earned to run your business? That's kind of what this ratio is kind of telling us here. Okay, it's also referred to as the debt-equity ratio because debt, equity. Okay, so if we grab the numbers, we have them here. Total liabilities divided by total shareholders' equity. For Lowe's, there we go. We've got the numbers for Lowe's in there. What this is telling me is I've got $19, I guess, if you will. No, well, if the ratio is 19, right? I can't really put it into dollars. Well, I guess I can. You have $19 of liability to every dollar of equity. Is that smart? Is it not smart? Well, it kind of depends on what your policies are. In the previous year, it's 8.5. So really, they're running their business on liabilities. Not necessarily a bad thing. It's something called leverage, and we'll get there. All right. So there we go. Here's Home Depot's numbers. All right. So there's Home Depot's numbers. Well, what the heck? What's negative mean? Okay. Well, if we look back for a second, let me go back up. Look at these numbers. These are crazy. How do you have negative stockholders' equity? Well, you have negative stockholders' equity because of this very unusual situation on Home Depot. Home Depot repurchased its treasury stock out there in the market, and that's basically a negative on your stockholders' equity section. And they purchased so much of it that it drove the whole thing down to a negative stockholders' equity. That's so bizarre and so unusual that unfortunately, when we go to do our calculations, it makes our numbers look crazy too. So you know what that is? I mean, it's kind of like it's meaningless at this point when you have this negative number like this. It doesn't even make sense. I know I have a check mark there, but it really doesn't even make sense. But you can see that they've got, they don't nearly have as many liabilities as they do stockholders' equity. Let's say that number was, well, I don't even know. I don't even know how to explain that the negative numbers are so bizarre. Normal explanation is they have, $19 to every dollar of liability. But in this case, it's just too odd to really make any real judgment on. So one of the things I have in here, my students do in live class, face-to-face, is I have them circle what the safest numbers are here. So there you go. You can take a look at that and see if you would agree with them. All right. I'm going to pause this. We'll get into number 3, and we'll go through profitability.